Hi, this is Dr. John Rogers, and welcome to the Financial Independence Podcast. For most people, buying a house is the biggest investment that they will ever make. In this podcast, I'll provide you with a few tips about how you can negotiate with your bank to get a mortgage that best suits your budget. Remember, the goal is to pay as little as possible for the least amount of time because you don't want to become an indentured servant to your bank. So before going into the meeting with your loans officer, you must understand the terms or conditions of the loan so that you'll be able to negotiate the best deal possible. For example, whether the loan is a fixed or variable rate loan, the rate of interest on the loan, the duration of the loan, whether any upfront commitment fees required, and whether or not there's a need for you to purchase life insurance to cover the payments on the loan in the event of your untimely demise. You also have to be aware of two other important things. One that can disadvantage you, the other that can help you. First, the disadvantage. You need to know that the bank always has the upper hand in the negotiation process because the bank has something that you badly want, and that's money. And the bank also has time, which you don't have because you've probably already signed an agreement for sale, which is time sensitive. But on the other hand, you should know that in some banks, the loans officers receive a bonus at the end of each year depending upon the number of loans they have given out to customers. However, because the loan officers are employed by the banks, they must always look out for the best interests of the bank, which means that they will always start off the loan negotiation process by offering you a very high rate of interest because the more interest that you pay, the more money the bank makes. However, because the loans officer's yearly bonus is based on the total number of loan transactions completed each year and not the interest rate on each loan, they'll always be prepared to work with you on the interest rate that the bank charges you because at the end of the day, if you get the loan at a rate that meets your budget, then everyone is happy. That is you, the loans officer, and the bank. The most important of the conditions is the interest rate on the loan. You should know that you can negotiate the interest rate on your mortgage with your loans officer because a very small change in the interest rate charged can make a huge difference to your monthly payments and a big difference to how much interest that you end up paying over the life of the mortgage. For example, the monthly payments on a $250,000 15-year mortgage at 5% interest would be $1,977 per month. But if the interest rate was instead 7%, the monthly payments would be $2,477. That's a $500 a month difference. As a rule of thumb, you can know ahead of time exactly what your target interest rate should be. The way that you can calculate this is by looking at what is known as the U.S. Treasury yield curve, or the equivalent in other countries. This curve shows you the yield or interest rates on U.S. Treasury bills, notes, and bonds. The banks base the interest rate that they charge customers on their mortgages on the yield curve interest rates. For example, if you're getting a 15-year mortgage and the interest rate on a U.S. 15-year bond is say 5%, then the interest rate that the bank charges you will be between 0.75% to 3% over the 5% rate, depending upon your credit rating and prevailing economic conditions. So let's say that you have a good credit rating and economic conditions are good. Then the interest rate on your loan should be between 6.5 to 7.5%. If your loans officer tries to charge you more than this, then you can politely explain to him that if that's the best that he can do, then you will take your business elsewhere, I can assure you that 9 times out of 10, the loans officer will compromise and offer you a better rate because they're also thinking about their annual bonus. After you've negotiated the interest rate and the duration of the loan, the next thing is to ask the loans officer for an amortization schedule. This is a schedule that shows you all of your monthly interest and principal payments for the 15-year duration, if it is a 15-year loan. Each monthly payment consists of a principal payment and an interest payment. At the beginning of the mortgage, you pay mostly interest, and as you near the end of the mortgage, you pay more of the principal. So keeping this in mind, you can pay off your mortgage in half the time if each month you pay the full interest and principal and also pay the principal on the following month. Using this technique allows you to not only pay off your mortgage in half the time, but it also reduces the total amount that you would have paid otherwise. Now, you'll have to explain this to the loans officer, and more than likely, he will say to you, you can't do this. Of course, you can. So once again, you have to be firm, and the loans officer will eventually acquiesce to your demands. However, if you do this, then you must check every month the bank applies your extra payments to your loan. This may require that you go into the bank with your amortization schedule in hand and reconcile any differences between your payments and how the bank has applied your payments. The third thing that you need to be aware of is that the bank will sometimes want to charge you a commitment fee. This is a fee that they will tell you allows the bank to set aside money for your loan. Of course, this is absolute nonsense, as the bank actually creates money out of thin air each time it grants a loan. So there is no money that needs to be set aside. Therefore, you just simply tell the loans officer that the commitment fee is non-negotiable and that you're not prepared to pay it. Invariably, once the loans officer recognizes that you understand what time of day it is, they'll quickly back down on any commitment fees. When taking out a mortgage to the bank will usually require you take out an insurance policy equal to the amount borrowed with the benefits assigned to the bank, so that in the event of your untimely death, the bank will be covered for any outstanding monies owed by you on the mortgage. Often the bank will recommend that you obtain the required life insurance from a specific company. However, you should be aware the bank may either own the recommended company or have shares in it. Irrespective of whichever company that it uses, it's important that you buy the appropriate type of insurance coverage that suits your particular needs. Essentially, there are 3 types of insurance that you can purchase, namely term, whole life, and universal insurance. You should always opt for term insurance because it will cover your needs and is also the cheapest one to buy. And lastly, whether you get a fixed or variable rate mortgage depends upon whether or not you think interest rates are going up or going down. If you think interest rates are going up, then you get a fixed rate mortgage. If you think they're going down, then you get a variable rate mortgage. You can determine whether or not interest rates are going up or down in the future by simply referring to the US dollar yield curve or the alternative in other countries. So there it is. I provide you with all the information you need to get the mortgage that best suits your budget. So thanks for listening. And if you're interested in becoming financially more independent, then please feel free to subscribe to this channel.